Okay, let's think about something for a second. Imagine a world where the security of one really massive digital network could, like, effortlessly power countless others. I mean, how would that redefine the whole idea of trust in our decentralized future?
The fundamental shift, really.
Yeah, because that's pretty much the revolution that's, well, brewing right now in the Ethereum ecosystem.
It is. It's more than just a trend. It feels like a real re-architecture.
Yeah.
We're shifting from, all these separate trust networks,
Right, fragmented.
exactly
Yeah.
fragmented, towards a shared kind of composable security layer. And it uses Ethereum's massive economic weight to do it.
Welcome, everyone, to the deep dive. Today, we're plunging into, well, what we're calling the restaking revolution. This whole thing pioneered by EigenLayer, it's not some small experiment anymore, is it?
Not at all. It's become a dominant force. The total value locked, the TVL, it's blown past, what, $25 billion as of Q2 2025?
25 billion. Wow. So our mission today is to really unpack this. We want to understand the core mechanics, this explosive growth we're seeing, who the key players are, and also the implications, because they seem pretty profound, maybe even challenging for Ethereum and, the whole digital economy.
And we get a good base for this discussion, market reports, technical white papers, whole stack of analysis.
Great. So let's dive right in. Restaking. It sounds simple, like you're just staking your ETH again, but it's more complex than that, isn't it? What's the actual core innovation?
It is, yeah. It's a really fundamental innovation in crypto economic design. Think about traditional staking on Ethereum.
Okay.
You stake your ETH, and that capital secures one network Ethereum.
Yeah.
Restaking lets you, well, reuse that same commitment, that same state
But
capital.
we'll use it how?
You use its security potential to also secure other independent systems, so it's not one-to-one anymore.
Okay. So it becomes
It becomes a one-to-many relationship. That's the key shift.
one to many. I like that. And that directly tackles this thing the source is called the cold start problem, right? For these new protocols, the AVS.
Actively validated services, yeah. Historically, launching a new service like a bridge or an oracle or some data layer was incredibly hard.
Why? The tech.
Not just the tech, but bootstrapping trust. You had to convince people to stake capital just for your new thing. That takes immense time, immense capital.
Right. Building that validator set from zero.
Precisely. Restaking flips that.
Yeah.
Now, these new AVSs can essentially rent security from Ethereum's huge existing validator set, right from day one.
So it massively lowers the barrier to entry for new ideas.
Dramatically. It's like trying to build your own power plant versus just plugging into the grid.
Okay, that's a great analogy. And EigenLayer is the grid operator here, basically, the pioneer.
Pretty much. EigenLayer is the central hub, the pioneer,
Oh,
founded
yeah.
back in 2021 by Sriram Kannan.
Right, the former professor.
That's him. His vision was this open marketplace for decentralized trust. Their mainnet, stage one anyway, launched June 14th, 2023. That really kicked things off.
And it got serious funding too, didn't it?
Oh, yeah. Significant VC backing. $50 million from Blockchain Capital, and then a huge $100 million from Andreessen Horowitz, A16's crypto.
Wow. Okay, so the money's there, but technically how does it work? You said my ETH doesn't move.
Exactly. Your actual staked ETH stays put. Think of staking as giving you a kind of voting power in Ethereum security.
Okay.
EigenLayer doesn't touch your ETH. It just provides a way, through smart contracts, for you to extend that voting power, those attestation rights, to other protocols as well.
So you're essentially signing up for extra duties with the same collateral.
That's a good way to put it. You're using the same base trust commitment in multiple places.
But okay, if you get layered rewards, I'm guessing you also get layered risks. What's the catch?
That's the core trade-off, absolutely. You get potentially stacked rewards, but you also take on a compounded risk profile. It's correlated risk, meaning you're opting into additional slashing conditions. Rules set by the AVSs you choose to secure. So you could lose stake not just for breaking Ethereum's rules, but for messing up on an AVS too.
Right. More ways to lose your stake.
Yes. And it usually means more work for validators running extra software for these AVSs. Plus, longer unbonding times. EigenLayer itself adds a minimum 7-day escrow on top of whatever Ethereum requires.
So it's definitely not free yield. It's a whole different risk-reward calculation. The sources call it programmable security. Is that just jargon, or is this really a fundamental shift like DeFi money Legos?
Oh, I think it's absolutely fundamental. It's not just a new app. It's changing how we think about security itself.
How so?
It turns crypto economic security into something modular, programmable.
Hmm.
Like DeFi let you stack financial primitives, restaking lets you stack security commitments.
So Ethereum is the source of capital.
Right, Ethereum provides the raw security capital, EigenLayer is the marketplace connecting supply and demand.
And the AVSs are the customers buying security.
Exactly, it's moving away from isolated security silos towards this shared composable security as a service idea. It's a big deal.
Okay, let's shift gears to the market itself, because this growth, as you said, it's been explosive.
Truly explosive. EigenLayer's TVL on Ethereum alone. It shot past $11 billion by Q2 2025. That puts it among the absolute largest protocols in all of DeFi, not just restaking.
How did it grow so fast? Was it gradual?
Not really. It came in bursts, often when they lifted the caps on how much could be staked or when they added support for popular liquid staking tokens, LSTs.
Ah, like Frax's rsETH or Mantle's F.
Precisely. Adding those LSTs opened the floodgates. And we're talking real economic activity, too. Nearly $88 million in annualized fees, close to $95 million in programmatic incentives. It's humming.
And it seems most people aren't interacting with EigenLayer directly. These liquid restaking tokens, the LRTs, they're the main way in.
That's absolutely right. LRTs are dominating. They act as this crucial layer that simplifies everything for the user. They manage the complexity.
How much of the market do they control?
Around 80% of all the assets restaked on EigenLayer are flowing through LRT protocols. It clearly shows users prefer that liquidity and simplicity.
So who are the big players in LRTs? ether.fi seems to be way out in front.
ether.fi is the clear leader, yeah.
Hmm.
Around $6.37 billion in TVL, something like 56% market share just within the LRT space.
What's their edge?
Their non-custodial model is a big draw, plus they have massive DeFi integration, over 400 protocols except their LRTs. Then you've got Kelp DAO, which is strong, focusing on aggregating different LSTs.
Okay.
And Renzo, which positions itself more as a cross-chain strategy manager. Those are kind of the big three driving user adoption right now. But others like EigenPi, Puffer, Bedrock are significant too.
And this idea of shared security, it's not just staying within Ethereum anymore, is it? We're seeing cross-chain restaking pop up.
Absolutely. The concept's spreading. You've got Symbiotic emerging as an EigenLayer competitor on Ethereum, which is interesting.
Right.
Then there's Babylon, which is doing something really novel, pioneering Bitcoin restaking, using BTC's economic weight to secure other POS chains.
Wow, Bitcoin restaking.
Yeah. And even on Solana, you're seeing native solutions like Jito and Solaire exploring this. It suggests shared security is becoming a core architectural pattern across the whole blockchain space.
Okay, but let's address the elephant in the room, this points economy. It feels like the fuel for all this growth, but also maybe unsustainable.
It's a massive concern. You're right. The growth is overwhelmingly driven by speculation on points, EigenLayer points, Renzo ES points, Kelp miles, you name it.
And everyone assumes these points will convert to valuable tokens via airdrops later.
Precisely. The main yield attracting billions right now isn't actual fees paid by AVSs for security services. It's the anticipated value of future airdrops.
So what kind of capital does that attract? Loyal users?
Not necessarily. It attracts what people call mercenary capital, participants who are here for the short-term incentive, the airdrop points.
And they might leave once they get their tokens.
That's the risk. A sudden exit of capital could cause a sharp TVL drop, potentially depegging LRTs, triggering liquidations. Yeah. Basically, a crisis of confidence in the whole model.
So there's huge pressure on the AVSs to actually start generating real revenue to pay for security soon.
Immense pressure. This points-fueled growth phase can't last forever. The underlying economics need to become sustainable.
Okay, let's talk more about those AVSs, the actively validated services. They're the ones actually demanding all this shared security.
Correct. They are the demand side of the EigenLayer marketplace. They're decentralized protocols or services. Could be anything from bridges to oracles to sequencers.
And they use EigenLayer's pooled security for what exactly?
To ensure their own integrity and operation. They typically involve on-chain smart contracts and off-chain node operators running their specific software.
And if those operators mess up?
The AVS defines specific rules. If an operator acts maliciously or just fails to perform their duties according to the AVS's rules, their delegated stake, managed via EigenLayer, can be slashed.
So what are the big use cases? What kinds of AVSs are actually live or launching and using this security?
Data availability, or DA, is probably the most prominent right now. EigenD, which is developed by EigenLabs themselves.
The core team, right?
Yeah. It offers a cheaper DA solution for Layer 2 rollups. It was the first major AVS to launch on mainnet and actually start distributing rewards, though the rewards are tiny right now.
Okay, DA is one. What else?
Decentralized sequencing and achieving fast finality for rollups is another big one. You have AltLayer with their restaked rollups and MACH service.
Right, for faster confirmations.
Exactly. Espresso Systems is also building a shared sequencer marketplace. Then you have oracles like Oracle, coprocessors like Brevis for ZK data access.
ZK, zero knowledge.
Yep. And interoperability is huge, too. Bridges like Hyperlane and Omni Network are using restaking to boost their security. Lagrange is doing interesting things with ZK state proofs.
But you mentioned the rewards from EigenLayer are tiny. That seems to be the case across the board, right? Most AVS aren't profitable yet.
That's the critical issue right now. Most are pre-revenue. So the market is currently sustained almost entirely by EigenLayer distributing its own IGN token as rewards, plus speculation on future AVS token airdrops.
Not by AVSs paying sustainable fees for the security they're consuming.
Not yet, generally. That EigenLayer reward, for example, translates to something like a 0.003% APR for restakers. Because the TVL is so enormous, it's negligible.
So this battleground for security we hear about, where AVSs compete for staked capital, it's currently fought with speculative tokens, not real cash flow.
Exactly. They compete by promising future airdrops. And AVSs can set different slashing rules too. Objective, subjective, or this intersubjective model, where the IGN token itself is used to resolve disputes through voting.
But for this to last, that has to change, doesn't it? The battle needs to be fought with actual revenue.
It absolutely must shift towards sustainable, revenue-generating business models. AVSs need to be able to afford the security they use. Otherwise, capital will flow away, and you'll see massive consolidation. The current incentive model is just a temporary bridge. Okay, very clear. Let's circle back to the user experience and the LRTs, the liquid restaking protocols. You called it a DeFi minefield. Why? How do they simplify things but also add risk?
Well, they simplify things immensely. They act as these aggregation layers. You deposit your ETH or your LST, and they handle the complex part of selecting AVSs, managing operators, etc. In return, you get a liquid token, an LRT.
Like ether.fi's ETH or Renzo's ETH.
Exactly. And you can take that LRT and use it all over DeFi lending, trading, whatever. That's the appeal.
But what's the minefield part?
The risk comes from a few places. One is peg stability. These LRTs should trade close to the value of the underlying ETH or LST, but there's withdrawal friction.
Because of EigenLayer's waiting period.
Right, that minimum 7-day escrow plus any Ethereum unbonding. It means you can't instantly redeem your LRT for the underlying asset. So during market stress, if lots of people try to sell their LRTs, the price can significantly depeg from the asset it represents.
That could cause problems elsewhere in DeFi if people are using it as collateral. Big problems. And that leads to the other minefield aspect. Leverage and composability.
The yield stacking.
Yeah, this is where it gets wild.
Right.
People take their LRTs, deposit them on lending platforms like Anove or Morpho Blue,
Borrow against it.
borrow stablecoins or ETH against it, then use that to buy more LRTs, deposit that, borrow more. It's called looping.
To amplify the points and yield farming rewards.
Exactly. You're amplifying your exposure. And platforms like Pendle Finance even let you split the LRT into its future yield component and principal component and trade those separately. Gearbox offers leveraged farming.
It sounds powerful for returns, but incredibly risky.
It is, because you're massively amplifying risk too. This looping leads to double counting assets. The same underlying ETH is supporting multiple layers of debt and LRT value. It creates hidden, interconnected leverage throughout the system.
Like crypto-native rehypothecation.
Precisely. Pledging the same collateral multiple times. If a major LRT depegs sharply, it could trigger a cascade of liquidations across all these platforms, a real death spiral scenario. It's complex and potentially very fragile.
That kind of fragility usually scares off institutions, yet we're seeing them dip their toes into restaking. How are they navigating this?
Yeah, the institutional frontier is definitely opening up, but they're approaching it very differently, much more cautiously.
How so?
We're seeing institutional-grade infrastructure emerge. Big staking providers like Figment, Blockdaemon, they're offering streamlined native restaking services, not just LRTs.
Okay.
And crucially, qualified custodians think Coinbase Prime, Anchorage Digital Bank are now offering custody specifically for restaked assets. That's a huge signal of growing institutional comfort.
And they're getting tailored products too, like restaking as a service.
Exactly. Things like Renzo's institutional restaking vaults built with concrete finance. These let institutions create bespoke strategies, choose specific AVSs, set their own risk parameters, use professional node operators, and get audit-level reporting.
So it's not just about chasing yield for them?
Not primarily. The base ETH staking yield is low, maybe under 3%. Restaking offers a bit more, maybe 3–6%, but it's riskier.
Yeah.
For institutions, it's more about strategic exposure to this whole modular blockchain ecosystem, this new security paradigm, but done in a compliant, de-risked way.
How are they de-risking it, given the issues we discussed?
Through specific risk management tools.
Yeah.
One key idea is modular slashing or risk isolation.
Meaning?
They structure things so that if slashing occurs for one AVS in a specific vault, the losses are contained within that vault and don't spill over to others. They're building firewalls.
Okay, that makes sense.
Plus, things like slashing insurance are becoming a selling point. Providers like Blockdaemon or Puffer Finance might offer guarantees. And rigorous, repeated audits from firms like Halborn or PeckShield are absolutely table stakes for institutional products.
It sounds like this is creating two different markets, almost.
That's exactly what our sources suggest, a market bifurcation. You have the high-risk, high-reward retail market chasing points, using leverage loops.
The minefield.
Right. And then you have this emerging institutional market, lower yield, focused on compliance, curated strategies, risk isolation. It's leading to this financialization of risk itself.
How do you mean?
New products are being created around managing restaking risk, these curated vaults, insurance products. It starts to look a bit like structured products in traditional finance, like CDOs.
Which has implications.
It has implications.
Yeah.
Adds complexity, potentially hides risks if not managed incredibly carefully. It's bringing TradFi structuring techniques into DeFi risk management.
Okay, let's zoom out again. What does all this mean for Ethereum itself? You called it a double-edged sword earlier.
It absolutely is. On the one hand, the potential upside for Ethereum is huge.
How so? Boosting security.
Yeah, by increasing the utility and potential yield of staked ETH, restaking encourages more ETH to be staked in the first place. More staked ETH means higher economic security for Ethereum, making attacks more expensive. It feeds the security budget.
Okay, that's the positive edge. What's the negative?
The negative is the added complexity and risk for Ethereum validators. They now have potentially more demanding tasks running AVS software, maybe diverting focus. And critically, a chunk of Ethereum's core security collateral to the restaked ETH is now exposed to failures in external systems, AVSs, that Ethereum itself doesn't control.
So a failure in some random AVS could theoretically impact Ethereum's staked capital.
Correct. But stepping back again, philosophically, restaking really does seem to deliver on that modular blockchain dream, right? Shared security as a service. It totally embodies that thesis. Instead of every new chain or service trying to build its own little island of trust, fragmenting security, they can tap into Ethereum's massive security pool.
Renting security, as you said.
Exactly. It makes the whole ecosystem potentially much more efficient and allows innovation to focus on the service itself, not just bootstrapping security.
But there are major concerns, systemic risks. Vitalik Buterin himself has warned about some of these. What are the biggest red flags?
Well, the rehypothecation aspect we touched on is one. Layering liabilities on the same collateral creates hidden leverage and interconnectedness. Some compared to the structure of CDOs before 2008.
Okay, that's a sobering comparison.
Then there's the risk of correlated slashing. Imagine a bug in a popular AVS software run by thousands of validators.
They could all get slashed simultaneously.
Precisely. A mass slashing event could cause huge capital losses, destroy confidence, maybe even trigger LRT depegs and liquidations.
Yeah.
We saw a tiny preview with the Anchor exploit back in 2022, how failures can cascade.
And then there's Vitalik's big worry. Social consensus overload. What's that about?
This is maybe the deepest philosophical risk. Ethereum's strength is its credible neutrality, the idea that the rules are the rules, applied fairly and predictably.
Okay.
Now imagine a catastrophic failure in a systemically important AVS or LRT. Billions in restaked ETH are slashed. There would be immense pressure on the Ethereum community, the social layer, to intervene.
Like a bailout, a hard fork to reverse the slashing.
Exactly. Pressure for a non-standard state change to make stakers whole. But if Ethereum does that, if the community overrides the protocol's rules based on the outcome,
it breaks that credible neutrality.
it shatters it. It signals that the rules can be changed if the consequences are bad enough, which undermines the whole foundation of a trustless system. EigenLayer's founder says AVSs shouldn't expect L1 bailouts, but in a multi-billion-dollar crisis. Whether that stance holds is a huge open question.
So restaking makes Ethereum potentially the central bank of trust for this new economy.
Yes, it elevates ETH's strategic importance massively.
But it also ties Ethereum's own stability and reputation directly to the risks and successes of this vast, external, maybe less scrutinized restaking ecosystem.
That's the bargain. It's a very high-stakes integration.
Heavy stuff. Okay, let's talk governance and regulation, because this whole area feels like it's operating in a gray zone.
Definitely a gray zone. Maybe even a regulatory minefield waiting to happen. The legal ambiguity is significant.
Any specific signs?
Well, yeah. Back on May 29th, 2025, the US SEC staff put out a statement about staking, but they explicitly excluded liquid staking and restaking from their guidance.
What does that signal?
It signals they see these as much more complex, potentially problematic instruments requiring stricter analysis. They didn't give them a pass.
And the LRTs themselves, they look a lot like securities, don't they? Based on the Howey tests.
Many legal analysts think so.
Yeah.
You've got pooling of assets from investors, and the returns depend heavily on the active management and strategy choices of the LRT teams. That sounds a lot like an investment contract, potentially making them securities.
Which would mean a whole lot more regulation.
A whole different regulatory regime, yes.
Yeah.
Registration, disclosures, compliance.
Now, despite all the talk of decentralization, the sources point to a real centralization problem within restaking itself. How bad is it?
It's quite significant and a real paradox. Because LRTs dominate, they tend to channel the capital they gather towards a small number of large professional node operators.
For efficiency and reliability, presumably?
Right. But the data shows extreme concentration. Something like 10 entities control maybe 80% of all restaked assets, and just 7 node operators manage around 75% of the capital delegated by the LRTs.
Wow, that's very concentrated.
It creates an oligopoly. These few players have huge influence over which AVSs get secured, how risks are managed. It introduces systemic single points of failure and really runs counter to the decentralization ethos.
And that concentration, plus looking like financial intermediaries, that sounds like it puts LRTs squarely in regulators' crosshairs.
It seems likely. That level of concentration makes the top LRTs look systemically important. Regulators might push for them to register as financial service providers, imposing KYC/ML rules, capital requirements, the works.
Which could change the landscape entirely.
It probably accelerates that bifurcation we talked about. You might get regulated, permissioned LRTs catering to institutions, operating alongside the existing permissionless ones, potentially serving different markets.
Okay, looking forward then. What's the final verdict? Does restaking enhance Ethereum's moat, or does it compromise it?
It's still playing out, but it truly is that duality. It could massively widen Ethereum's economic moat. If ETH becomes the go-to collateral for securing a huge range of services, its utility and demand skyrocket.
Making it indispensable.
Right. But that comes burdened with all these new, complex, potentially existential risks we've discussed. Risks that could damage confidence in ETH or overload its social consensus mechanism. The outcome really boils down to managing complexity.
And where's the next wave of adoption likely to come from? Restake rollups seem key.
Definitely. The deep integration with layer 2s and rollups is a primary growth vector. Projects like alt-layer building rollups that use AVSs for core functions like sequencing and finality.
Yeah.
That's huge.
So L2s become major customers for restoked security.
Exactly. You see other L2s like Cyber, DoD, Chain using Agenda, Swell L2s designing its whole architecture around AVS integration. L2s need cheap, robust security and finality, and restaking offers a compelling solution.
And analysts seem bullish for 2025, right? Despite the risks.
The consensus outlook is that restaking remains a dominant narrative, yeah. Often compared to the impact liquid staking had a few years ago, DeFi growth forecasts are huge, and restaking is seen as a key catalyst. The block reported TVL over $24.7 billion by end of 2024 already, so the momentum is there.
So fundamentally, restaking is changing what ETH is as an asset.
It really is. It's evolving ETH from just the asset of one platform into potentially the base collateral for a whole new internet-native trust economy.
Which could create a supply shock.
Increased structural demand for ETH to be locked in staking and restaking could definitely reduce the liquid supply, potentially supporting its price and solidifying its role as a core digital reserve asset. But again, its value becomes ever more tied to the success and the risks of this entire restaking ecosystem built on top of it.
Okay, so wrapping up this deep dive, it really is this powerful double-edged sword, incredible innovation, but matched with equally significant, complex risks.
Yeah, it's the core tension. And the crucial thing to watch, the make or break transition, is whether this ecosystem can move beyond the speculative, points-driven casino phase,
Right.
towards becoming a mature, sustainable marketplace where AVSs generate real revenue and pay fair market rates for the security they consume. That's the foundation it needs for the long term.
So a final thought for you, our listener, to ponder. As you watch this restaking revolution unfold, what do you think will ultimately define its success? Will it be the sheer power and promise of shared security? Or will it be the harder realities of building sustainable business models and Ethereum's challenge to maintain its credible neutrality if or when the first major crisis hits?